Something shifted in the financial markets recently, and if you're paying attention, you felt it. The sharp decline in silver prices caught headlines for a few days, sparked debate across financial media, and then seemed to fade from view. But that volatility wasn't just another price swing in a volatile asset. It was a signal, a crack in the surface of a much larger structure that's been under stress for years. If you hold silver, or if you've been watching precious metals closely, you're probably wondering what just happened and what comes next. This video isn't about predicting where silver goes tomorrow or next week. It's about understanding what this moment reveals about the broader financial system and how thoughtful investors should be thinking right now. We're going to walk through this calmly and clearly. No hype, no panic. Just the facts, the context, and the framework you need to make informed decisions in what's likely to be a very consequential period ahead. Because here's what most people miss. The crash itself isn't the story. The crash is the trigger. What follows in the months ahead, the ripple effects across markets, currencies, and investor confidence, that's what matters. And that's what we need to understand together. Let's start with what we know. Silver experienced a dramatic price correction over a compressed time frame. The move was sharp, sudden, and caught many participants off guard. Volatility spiked, positions were liquidated, margin calls were triggered across futures markets. For anyone holding leverage positions, the damage was swift and severe. But this wasn't an isolated event happening in a vacuum. Silver has been gaining attention for months now, driven by a combination of industrial demand narratives, monetary concerns, and renewed interest from retail investors who remember what happened in previous precious metals rallies. The price had climbed significantly, momentum built, sentiment turned increasingly bullish. And as always happens when sentiment becomes one-sided and leverage enters the equation, the market became fragile. All it took was a trigger, whether that was profit-taking from large holders, a technical breakdown, or coordinated selling pressure, to tip the structure over. The specifics of who sold and why will be debated for weeks. But the mechanics are clear. A crowded trade, excessive leverage, and thin liquidity created the perfect conditions for a violent shakeout. That's not conspiracy, that's how markets work. So why does this matter beyond the silver market itself? Because silver doesn't trade in isolation. It's connected to gold, to currency markets, to inflation expectations, and to broader concerns about monetary stability and sovereign debt. When silver moves violently, it sends signals about risk appetite, about leverage in the system, and about how much stress is building beneath the surface of seemingly stable markets. This crash happened at a moment when central banks are navigating an impossible dilemma. Inflation hasn't been fully tamed despite aggressive rate hikes over the past few years. Economic growth is slowing in major economies. Debt levels, both public and private, are at historic highs. And currency markets are showing signs of instability that haven't been seen in decades. Silver, along with gold, has historically acted as a barometer for monetary anxiety. When confidence in fiat currency systems weakens, when investors worry about debt sustainability, when inflation fears resurface, precious metals attract capital. They become insurance. They become a store of value when other stores of value are being questioned. The fact that silver experienced such a violent correction after such a strong run tells us that the market is conflicted. It tells us that sentiment can shift rapidly. It tells us that leverage is still deeply embedded in the system, ready to amplify moves in both directions. And it tells us that we're likely in the early stages of a much larger repricing of risk across multiple asset classes. Let's zoom out and look at the forces that have been building for years. Global debt has exploded since the financial crisis of 2008. Governments responded to that crisis with unprecedented monetary stimulus, quantitative easing, and deficit spending. That created a recovery, but it also created dependencies. Economies became addicted to low interest rates. Asset prices inflated across equities, real estate, and bonds. And the ability to service all that debt became contingent on rates staying low. When inflation surged in recent years, central banks were forced to raise rates aggressively. That broke things. Banks failed. Real estate markets stalled. Government debt servicing costs exploded. And the conversation shifted from how do we stimulate growth to how do we avoid a debt spiral. Here's the uncomfortable reality. There's no easy way out. If rates stay high, the cost of servicing debt becomes unbearable for governments, corporations, and households. Defaults rise. Growth slows further. Recession pressure builds. But if central banks cut rates aggressively to provide relief, inflation risks reigniting, and confidence in the currency itself begins to erode. This is the trap. And precious metals, particularly gold and silver, historically thrive in this environment, not because they generate cash flow or earnings, but because they represent an alternative. They can't be printed. They can't be debased by policy decisions. They exist outside the system that's currently under stress. So when silver rallied hard in recent months, it wasn't just speculation. It was a reflection of growing awareness that the macroeconomic backdrop is deeply unstable. And when it crashed, it didn't resolve that instability. It simply revealed how quickly sentiment can shift and how fragile positioning had become. Markets don't move in straight lines. They never have and they never will. Every significant bull market in history has been interrupted by violent corrections that shook out weak hands, punished leverage, and reset sentiment. The investors who succeed over the long term understand this. They expect volatility. They prepare for it emotionally and financially. They don't panic when prices fall because they understand that corrections are part of the process. What we just witnessed in silver is a classic shakeout. Prices rose too far, too fast. Retail enthusiasm built, leverage increased, and the market did what markets always do in those conditions. It corrected violently to clear out excess and reset positioning. This doesn't mean the bull case is broken. It means the market needed to breathe. It needed to punish speculation and reward patience. It needed to separate those who truly understand the asset from those who were just chasing momentum. Think about every major bull market in precious metals history, the 1970s, the early 2000s. Each one was characterized by periods of explosive growth followed by brutal corrections that convinced many investors the move was over. But those corrections were just pauses. They were opportunities for disciplined buyers and tests of conviction for holders. The psychology of these moments is predictable. After a crash, fear dominates. Headlines turn negative. Analysts who were bullish suddenly turn cautious. Retail investors who bought near the top panic and sell at a loss. And quietly, in the background, longer-term capital begins accumulating again. If you currently hold physical silver or silver-related investments, you're likely asking yourself what you should do now. First, take a breath. The worst thing you can do in moments of volatility is make emotional decisions. If you bought silver as a long-term store of value, as protection against monetary instability, then nothing about your original thesis has changed. The debt hasn't disappeared, the inflation pressures haven't been resolved, the currency concerns haven't evaporated. What's changed is the price. And price volatility is not the same as fundamental deterioration. If you bought silver with money you need in the short term, or if you use leverage, then you're in a different situation. That's a risk management problem, not a silver problem. The asset itself remains what it always was, but your exposure may have been mismatched to your time frame and risk tolerance. For those holding physical metal, this is a moment to reassess your position size and your conviction. Do you still believe that monetary policy is unsustainable? Do you still believe that inflation risks remain elevated? Do you still see value in holding assets outside the traditional financial system? If the answer is yes, then short-term price movements are just noise. This is not advice to hold blindly or to ignore risk. It's a reminder that selling after a crash, especially when the fundamental reasons you bought haven't changed, is often the worst time to exit. Volatility tests. Conviction. That's its purpose. If you don't currently hold silver, but you've been watching and considering whether now is the time to enter, the picture is more nuanced. Corrections create opportunities, but they don't guarantee immediate rebounds. Markets can stay oversold longer than seems rational. Sentiment can remain negative for extended periods. Just because an asset fell sharply doesn't automatically make it a good buy. What you need to ask yourself is not, did silver get cheap, but do I understand why I would own this asset in the first place? If your answer is purely about short-term price movement, you're going to struggle. Because volatility works both ways, and without conviction, you'll likely sell at the worst possible moment. But if you understand the macroeconomic case, if you see the debt dynamics and currency pressures and recognize that precious metals historically serve as insurance in these environments, then volatility becomes less frightening. It becomes expected, and it becomes something you can use strategically. The disciplined approach isn't to throw all your capital in after one sharp decline. It's to scale in gradually, to dollar cost average, to build a position over time rather than trying to time a perfect entry. Markets don't reward impatience, they reward process. And here's something critical. If you're considering entering now, you need to be comfortable with the possibility of further downside. Corrections often happen in waves. First wave down, brief recovery, second wave down. That pattern is played out countless times across all asset classes. So if you're going to start building a position, do it with the understanding that patience will be tested. Let's talk about what not to do, because this is where most people make costly mistakes. First, do not react emotionally to daily price swings. If you're checking prices multiple times per day and feeling anxiety with every movement, your position size is too large or your time frame is too short. Volatility is part of the game. If you can't handle it emotionally, you need to reduce exposure until you can sleep at night. Second, do not chase headlines or follow hype without doing your own research. Social media and financial forums are filled with confident voices making bold predictions. Some are genuine analysts. Many are speculators trying to validate their own positions. Your financial decisions should be based on your own understanding, your own risk tolerance, and your own time frame, not someone else's narrative. Third, do not use leverage unless you truly understand the risks and have experience managing it. Leverage amplifies gains, but it also amplifies losses and eliminates your ability to be patient. The recent silver crash wiped out many leveraged positions that would have survived if they'd been held in cash or physical form. Leverage turns volatility from uncomfortable to catastrophic. Fourth, do not ignore diversification. Precious metals can be part of a sound portfolio, but they shouldn't be the entire portfolio. Risk management means spreading exposure across assets that behave differently under different conditions. Silver might protect you in monetary crisis, but it won't pay your bills if you need liquidity tomorrow. And finally, do not assume this is over. One way or the other, the crash doesn't mean silver is going to zero. The rally before the crash doesn't mean it's going to the moon. Markets are complex systems influenced by countless variables. Humility about what we don't know is just as important as conviction about what we do. History doesn't repeat exactly, but it often rhymes. And when we look at previous periods of monetary stress and precious metals volatility, patterns emerge. In the 1970s, gold and silver experienced extraordinary bull markets driven by inflation, currency devaluation, and loss of confidence in monetary policy. But those moves weren't smooth. There were multiple corrections of 30, 40, even 50% that convinced many investors the rally was finished. Those who sold during those corrections missed the larger moves that followed. In the early 2000s, gold began a decade-long bull market that took it from under $300 an ounce to over $1,900. Silver moved from under $5 to nearly $50. But again, the path wasn't linear. There were brutal sell-offs in 2006, 2008, and others that tested conviction and shook out weak hands. What these historical episodes teach us is that volatility is the price of admission for assets that move on fundamental uncertainty rather than cash flow. Real estate produces rent. Stocks produce earnings. Bonds produce interest. Precious metals produce nothing except optionality and insurance against system failure. That means their price behavior is driven by sentiment, by monetary conditions, and by cycles of fear and complacency. Understanding this helps you maintain perspective when volatility strikes. It's not an anomaly, it's the nature of the asset. So where does this leave us? The crash in silver was real, it was painful for many, and it revealed fragility in positioning and sentiment. But the underlying forces that have been driving interest in precious metals haven't disappeared. Debt remains historically elevated. Central banks remain trapped between inflation and recession risks. Currency stability remains questionable, and investor anxiety about the sustainability of current policies continues to grow. What matters now is not reacting to short-term price action, but understanding the larger cycle we're likely in. If you hold silver, stay focused on why you bought it. If you're considering it, educate yourself on the fundamental case and approach it with patience and discipline. If you're unsure, take time to learn before making decisions based on fear or greed. The aftermath of this crash will unfold over months, not days. Markets will digest what happened, positioning will reset, and eventually, the focus will return to fundamentals. Those who stay calm, who manage risk intelligently, and who understand what they own and why, will be better positioned for whatever comes next. This is not the end of a story. It's the beginning of a new chapter. Stay informed. Stay disciplined. And remember that the goal isn't to get rich quickly. It's to protect and grow wealth intelligently over time. Thank you for watching. Stay thoughtful out there.